Hi, this is Cale Smith, Managing Partner of IIM Investment Management, and this is an after-the-fact narration of the slides that I presented last Saturday night, February 18th, 2012, at our third annual investor meeting. We held a meeting down here in Islamorada. Ended up being a very busy weekend. I know there were a few investors up north, and by up north, I guess I should say Miami, who couldn't make it down simply because there were no rooms available in Islamorada. So before we even get into the presentation, I guess I'd point out that next year we're probably going to do this meeting a little bit later in the year, maybe the April-May timeframe. It's just very busy in President's Day down here. The weather's beautiful, and there's probably a very clear correlation between the two of those. But we will try to push it back and allow a few more people to show up. Let's get into it. First slide is a message from my lawyer, and I'm not going to spend hardly any time on this other than to tell you that anything I talk about in these slides should not be viewed as formal investment advice in any way, shape, or form. Let's get into it. First real slide is just a snapshot of IIM and where we are right now in our third year of business. As of a couple weeks ago, had just under 11.5 million in assets under management, have 136 investors and a number of investors with more than one account here. IIM is an RIA, a registered investment advisor here in Florida, and also registered in Texas last fall. Also have investors in about 14 other states. It's a little bit of a misnomer, I guess. Although my firm is an RIA, I don't actually give investment advice per se. All I do is really just manage the two funds that I run, and those are called spoke funds. I'm not going to spend a whole lot of time this year on spoke funds in general. I probably spent too much time last year getting into the weeds of spoke funds. But for folks who are new to the crowd or new to the term, I will tell you that a spoke fund is a group of separate investor accounts that are all linked through technology to a core account that happens to contain, in my case, most of my liquid net worth. So spoke fund investors are really unequivocally in it together with the portfolio managers, the folks who own those funds. Spoke funds has been an interesting sort of hobby / developing business or developing revenue stream under the IIM business. Have helped a handful of guys set up their own spokes over the last year or two. I have a number more sort of in the pipeline. Yeah, it's just been a great way to meet other peers and new emerging portfolio managers who also want to manage their funds a little bit differently. So again, not going to spend a whole lot of time there. Already did that in the past. We'll can provide resources for more on spoke funds if you're at all interested. The more important thing I would point out for right now is that IIM is a value investing firm. Could easily spend a number of slides on value investing in general, but by value investing, it's probably sort of important to define what that is and where it is along the three channels, if you will, for professional investors. And this is greatly simplified. There are a number of other ways, but in my head, this is just kind of how I think about where value investing fits. Over on the left there, the box under number 1, we do take a long-term approach to things. Really believe in becoming a partner in a business that we happen to own shares of. I don't view a stock as much of Wall Street seems to these days, i.e. a piece of paper that changes hands 100 times a day. My concern and my approach is really much more driven by fundamental elements of the companies we invest in. And by that I mean specifically drilling down to financial statements and trying to come up with a value of the company based on those financials. I feel like what I really do on a daily basis is trying to identify the gaps between what the market believes a company is currently priced at and what I believe and can prove more or less through the company's financials. So it is sort of a long-term, it's almost anachronistic, I think, these days, especially when you consider the average stock, I believe, is held for about 22 seconds. So we are on the other end of that spectrum, and that's by definition. Number 2 there, the short term, I think this is probably how you'd categorize most of Wall Street's investment philosophy. There are fundamental sort of short-term traders, if you will, and those are folks trying to, I guess, figure out, for instance, Home Depot might have a good quarter next quarter because, I don't know, the hurricane came into town and a lot of people were buying plywood. But trying to really predict and or pick up on more short-term fundamental changes to things and profit from that. There's also a whole nother side of the business that candidly I don't quite understand, but there are plenty of adherents to it, and that's the technical side. And to be fair, there's a whole range of technical things that people can pay attention to, and even I pay attention to things like insider buying on a company-specific basis. But the stereotype, I guess, of a technical investor is somebody who spends a lot of time doing sort of event-level analysis rather than drilling deeper. And by that I mean looking at charts, trying to figure out what the next leg of the chart might look like, knowing nothing else about the company other than what the chart has done in the immediate past. There's lots of things, price/volume takes on the world and that sorts of things. The third channel over there to the right is the efficient market theory. I don't put a lot of credence in this myself. Plenty of people do, including really all of academia, and that is really more of sort of the traditional asset allocation approach to the world, index funds and putting your assets in different buckets, whether it's fixed income, equity, sometimes international equities, that sort of thing. At a higher level, I guess I should point out, I also sort of believe that there's really two ways to think about investing. You're either trying to grow your wealth, which is what I feel like we're doing, or you're trying to protect your wealth. And in that case, a lot of the efficient market, or more of the efficient market side of the house, I think probably makes more sense for folks. Diversification is going to be good there. It's just not something that I believe in much at all for our goals. You can't really have or talk about value investing in public without having at least one picture of Warren Buffett, I've decided. So here's my Buffett picture. Check that box. There's a good quote from him there that in a nutshell summarizes what we're trying to do. Business we can understand, long-term prospects, operated by good managers, and more important, available at a very attractive price. Again, check box number 2. Just wanted to underscore the difference between actually trying to value a business versus trying to guess which way the stock is going to go. Two completely different things, and they can be different things for a long period of time, especially in markets that are very volatile. So here's sort of where we are right now. I run, again, the two portfolios. Gecko Folio is my high yield / income fund. Of the 11.5 million in assets we have, it's probably 10-12% are in Gecko. I'll talk more about why that is in a minute. But for right now, it is still yielding a little bit over 7%. And on the column on the far left there, you can see the total return. Gecko's up about 135% since inception. That was at the end of January 2009. You can see our year 1 numbers, had a good year there, year 2. And even last year, though it was a tough year in the broader market, did eke out a small gain and continued to beat the broader index as well. The annual average there you see on the far right, that's just a straight unweighted average. It obviously doesn't necessarily represent the variability in the returns that we've had each year, but it has been a fund that I've been running for 3 years now, has been outperforming the S&P, and has grown about 35% a year in a straight average method. And this is Tarpon. This is sort of the, I guess, the good news, bad news slide, but first we'll start with our total return. Tarpon, again, is my long-term capital appreciation portfolio, so I really manage that for long-term growth. Was launched at the end of November 2008, a very auspicious time. Total returns about 124% versus 92 in the index, and you could read those first few bar columns as well as I can. I would point out it's a little bit unusual, or at least I feel like it's a little bit unusual, that my Gecko folio, the high yield portfolio, is, at least once these returns were figured here, outperforming Tarpon, the ostensibly slower growing, stodgier type companies have actually outperformed the more traditionally undervalued companies. I think that makes some sense when you step back and think about it. Specifically, there are a lot of investors out there who, when times get a little bit crazy like they have been the last few years, really put an emphasis on dividends and cash. And I think that more than anything has helped Gecko do as well as it's going to do. You can see our year one returns there. Had a very good year that first year. Year two, we're basically flat, underperformed. And then the bad news, year three. This is last year. Ended up down about 15% in year three. That stings. I will tell you that about 2.5 weeks before our year three ended in Tarpon, we're only down about 5.5%. So we lost a good 9-10% in the last, like I said, 2.5 weeks of the year for Tarpon. I'll also tell you that on the last trading day of our last year in year three, our biggest holding, which was Clearwire, dropped about 20% just in the last 2 hours. It went from about 2:00 p.m., a small maybe 1% gain, to being down 20 for the day. I didn't yet, or I probably never will, go back and try to figure out what our year three numbers would have been exclusive of Clearwire falling off the cliff at the last minute. But the point is, that's just the sort of year it was. Also, I guess the underscores really doing it for the long term, and that really shows up, I guess, in year four, ironically. The point being, although year three was tough, and that number certainly stings, I'm happy to tell everybody at the annual meeting that in the first 2.5 months of Tarpon's year four, we've already made up that loss we had in year three. So, I suppose it may ease this thing a little bit. I think this also probably goes without saying, but I remember mentioning it at the night of the meeting too. Excuse me. If you have a $100 stock and it drops to 50 and you sell, then that's a 50% loss. To make it back up, though, I think people grasp this, but you don't just need a 50% gain. It's a 100% gain to get back from 50 to the original $100. So we needed to basically go up 30% to make up for last year's losses, and to date we're up about 34%. So that is a good thing, I think, by all accounts. Again, you can see the other annual average there on the far right. Again, it's more just how the math works than indicative of any sort of I guess smooth performance measures, but that is sort of where things are. This is a picture I found on the internet, so number one, it must be true, but I also felt like it was a good snapshot of where different strategies ended up the year. It is a tough year in 2011 for many different kinds of strategies. If you look down at the bottom in the orange box, though, that is us. That is our fundamental value strategy. Again, this specifically relates more to hedge funds. There are some mismatches between when Tarpon year end is and where Gecko year end is versus this, which is just the little end of the calendar year. But I think you get the point. It's a tough year for fundamental value strategies, and there's no exception for Tarpon. The bottom there is where Tarpon was. Again, there's our negative 15% return, and Gecko again eked out about 7% return. So I think it's good to look at this and come to maybe a couple conclusions. Number one, again, 2011 was a tough year for a lot of folks. The question is, well, why was that? And I think it's reasonable to go back and say, well, historically it had a lot of volatility periods throughout the year, mostly led to Europe, also the debt ceiling debacle here in the U.S. But both those really led to, I think, defensive positioning among a lot of professional investors, and sort of by default, high asset correlations. People, in other words, just really wanted to get out between really two vicious bear markets in the last 10, 11 years. I think between a real reality check and how dysfunctional DC has been, pessimism was very high, and that certainly showed up in many ways in 2011. This continued.